Good afternoon, traders and investors. Will back here with another one, and hopefully all you guys have been having a very beautiful weekend so far. Now, welcome back again to another edition of our subscriber request videos. These videos are where I go through the comment section, guys, and pick out your recommended stock tickers to do some analysis upon. Now, I'm going to spend about 3 to 5 minutes per ticker. We're going to go through some brief fundamental analysis and some brief technical analysis for the company as well, and my overall opinion on these companies. So, going to be very interesting today, guys. We have about 10, 11 different requests provided by you guys. So once again, thank you very, very much for providing these tickers. Now, of course, with so many stocks in the stock market, I know a lot of them, but I do not monitor all of them at the same time. So I really appreciate your guys' efforts in bringing forward some tickers that I may have just overlooked in recent market action. So that being said, guys, a lot to cover in today's video. Let us jump right into it. And the first thing that I wanted to start off with was the criteria that I use when filtering through stocks that I'm looking to add potentially for a long-term portfolio. Now, obviously, these conditions won't necessarily be for short-term swing trades, but for longer-term portfolio buys that we're looking to hold for the next 5 to 10 years, these are the criteria that I look for. So always remember, guys, a stock's price is a reflection of future earnings and future cash flows. So it stands to argue if these two things are not going up in a meaningful fashion over the future, the stock's price also will not be allowed to go up or increase in value from Wall Street, right? Now, number 2, do not chase the market ever, guys, regardless of the company. Let the market come to you. There's over 500 blue chip stocks in the market right now and over 8,000 tickers total that we can trade that aren't penny stocks, of course. So there's always some opportunities ahead of us. Now, what are the criteria that I look for in a very solid company, something I want to add to my long-term portfolio? Well, number 1, the company needs to have a competitive advantage in its industry, aka a moat. When you have a moat, guys, the rest of everything is extremely easy to do. When you have a commanding market share, when you're an industry leader, it's very easy for you to increase prices because there's not that much competition out there for your product or service. And when you increase prices, that does translate to increases in revenue, increases in EPS, and increases in free cash flow too. So the importance of a moat, guys, is excessively important, especially when looking at companies for the next 10 to 20 years. Now, you want these companies to have consistently increasing revenues and EPSs, right? To give you guys an example, let's take a look at Microsoft right here. And you can always come down to the Trading View tab on the right-hand side, click on this See Forecast button down here, and just take a look. Are they expanding EPS consistently? Are they expanding revenue consistently as well? Very big criteria to look out for a company, guys. We want consistency and predictability in these companies. Consistently increasing free cash flow as well. Free cash flow is very important, guys, because what can they do with that free cash flow? Well, they can either pay dividends or buy back shares. These are two things that will increase your total returns in the company. So another metric that I very closely follow. Next, you want to target companies that have very high returns on capital employed or returns on invested capital. These are internal metrics, guys, of when a company receives money, either through its sales pipeline or through its investment channels. How well are they able to utilize that cash, right? Can they leverage the internal cash properly? Usually for high quality, high conviction companies, I look for over 15% in these two criterias. Number 5, we want to target companies with relatively low debt in relation to the amount of revenue that they bring in, right? The company can have very high debt, like, something like $20 billion, $30 billion worth of debt. But if they're bringing in $30 billion in revenue per year, then that's okay. You want to avoid companies that have very high debt profiles, but do not have enough revenue to ever be able to service that debt in a meaningful fashion. And then lastly, we want to combine very high quality fundamentals with a great technical entry, right? At big support levels, you want to be waiting for pullbacks on these stocks to either daily, weekly, or monthly, very large support areas. This is why I say the name of the game is solid fundamentals and a great technical entry. So with that out of the way, guys, let us first jump into our number 1 request, and that is going to be from Burra. Let's just call him Burra, right? Or he or she. So enjoying these so much. Can you look into ASTS when possible? Yes, absolutely. So the Wall Street Bets crowd definitely having a very fun time with this stock, of course. Extremely high growth, high momentum stock. Well, in terms of high growth, I mean, their growth is really going to start coming 2027, 28, 29. If you don't know what they do, guys, essentially they are in the same business as Starlink, right? They are deploying satellites into orbit to provide communication services in areas that you don't necessarily have the best service. As of now, they have partnerships with AT&T and Verizon, 2 out of the 3 largest mobile providers in the United States. And those are pretty much the only deals that they have in the pipeline right now. So far, nothing so much in terms of internationally, but they did launch in this most recent week 5 new satellites into orbit right now. Now, one of the things with this company, guys, that I just mentioned before is that they're not really going to see any meaningful revenue much before 2027. At that point, they will be having approximately $3 billion in revenue. And by 2030, it is estimated that the company could be bringing in between $5 to $6 billion in revenue. So just to give you guys an idea in terms of their competition, Starlink, right? Well, Starlink as of this year has $6.6 billion in revenue, and their valuation, they're not a public company, they're privately owned, so you cannot see any public share price or anything like that, but the private valuation here is about $120. So we can estimate this to be just about 20 times sales, right? Roughly 20 times their sales is going to be somewhat their valuation. Now, it's slightly under. You can say it's actually about 18 times, but you guys get the point, right? It's just to give us an estimate of how the markets, how private equity, or maybe even the public markets like this are going to value this company. So ASTS, $3 billion in 2027. If we were to give them somewhat of the same valuation metrics between, let's say, 10 and 20 times price to sale, let's call it 15, right? Just to give a possible middle ground right there. Well, we can see, right, $3 billion times your 15 right there, they could possibly be anywhere between a $30 to $50 billion company by 2027 when they realize that revenue. Now, obviously, there's some things that could stand in the way, right? Starlink can very easily replicate ASTS's business. They are one of the main competitors right now. And funny enough, Starlink is using SpaceX's rockets to deploy their satellites, right? Which also Starlink does do as well. Both of Elon Musk's companies, right? SpaceX and Starlink go hand in hand. So ASTS definitely does have its work cut out for them, but has been one of the most interesting momentum-based stories in the marketplace, at least in the last few months. The shares pretty much coming up more than 10x, right? Pretty much almost 20x at the peak right there. So as of now, it is still a very speculative bet, guys. So if you're in this one for the long term, for this possible $30 to $50 billion valuation, it stands to argue, guys, you'll probably have to be patient with this one, right? If you have to buy into the stock right now, you have to let the long-term thesis play out. And at that point, right, the market cap of this company right now is about $8 billion. So if we're forecasting possibly $40, $50 billion valuation, there could be a 5, 6x in this stock over the next possible 3-4 years type of thing. I do not think it's going to happen right away. This is essentially extreme momentum to the upside, and they're trying their best to kind of front run these possible gains for the company. So that is what it is in terms of the fundamentals. In terms of the technicals right now, guys, right? Technicals are not looking too bad. Of course, daily downtrend, the bulls are trying to get a bounce attempt to reset the daily uptrend in motion right now. Personally, myself, I would be possibly interested in playing this company just due to the volatility, maybe with some short put options in the lower $20 range. The lower $20 range, guys, gives ourselves a much more decent valuation, closer to around the $6 billion mark. So I wouldn't mind making an attempt at this company down here. If you have shares for now, guys, it really all depends on why you're in the company, right? If you're in it for the long term, well, suffice to say that, especially if you're in from all the way down here, in my humble opinion, kind of maybe better off just holding the shares. It will be extremely volatile, of course, but if you're in it for the long run, I don't see any immediate reason to sell right now. And of course, if you're trading the stock here, guys, just go with our more defined close levels in terms of being able to set stop losses and your take profit levels, right? So very high momentum based stock. I would be very cautious with any call options right now. You really want to do some call options when the stock really starts getting crushed, right? When we're in a big daily downtrend swing and the stock maybe have a negative day of about 6, 7, 8% into a larger form area of support, these could be some good locations to kind of tag those call options off. So that's it for pretty much company number 1. Company number 2, Burra again. Asking, can I do Texas Roadhouse for a 1-2 year analysis? Yes, no problem, Joseph Carlson. We can absolutely do Texas Roadhouse. So let's take a look at Texas Roadhouse right here, right? Wink. So let's take a look at Texas Roadhouse. So Texas Roadhouse, guys, is, one of the more solid food companies out there, or should I say not food company, but more of a restaurant brand, a sit-down restaurant chain experience. It's known as one of the best steakhouses in terms of bang for your buck, in terms of the value that you get when you go to one of their establishments. And the one good thing about Texas Roadhouse, I've been following this company not too long, admittedly, maybe only for the last 2-3 years, but the one thing that everybody says is their ability to scale multiple different locations without losing any quality. And you guys know how hard it is for a restaurant chain to do this, to scale properly without forfeiting any quality when you visit one location to the next, right? Now, obviously, this has to do with a bit of their franchise model and how they incentivize franchisees to keep the quality very high to get a lot of bonuses, essentially, right? So a very, very, very strong company, very high quality, but also the fundamentals of the business are very, very good. Take a look down here, guys, in terms of their free cash flow. We can see that the company does bring in a very meaningful amount of free cash flow per year in relation to the debt that they have, and they do still have a little bit of cash on the balance sheet right now. So free cash flow looking very decent for the company. In terms of net margins, I mean, it is a restaurant business, but in the past couple of quarters, they have put in fairly decent net margins too. Take a look at this right here. Here's their profit margin history. You can see that, of course, we did have the pandemic dip. Well, because nobody could go there, right? But they have been steadily making a comeback now in the past 3 to 4 quarters, back to roughly the gross margins that they were having prior to the pandemic. Operating margins in the middle here show roughly the same amount of growth back to prior to the pandemic levels. And their net margins are actually some of the highest that they've been in the most recent couple of quarters, but nothing crazy, right? It's not as if they doubled net margins, but margins are very good for the company. What they do as well is they do a number of buybacks on their shares. So take a look at this. Here's their shares outstanding, and you can see they've repurchased roughly about 10% in shares outstanding over the last 5 years for the company. So they're really utilizing that free cash flow as best as they can. In terms of the growth forecast of the company is looking very good, guys, for the next couple of years. Ever expanding EPS and ever expanding revenue as well. Very consistent for their current business model. Now, in terms of the valuation here, guys, well, they are growing revenue and EPS at very healthy amounts per year. This is through 2027. And now take a look at the valuation. Forward PE at $164 is about a 25.9. 25.9 is not all that bad in relation to the history of the company, right? If we're going to take a look at their historical PEs, usually you can see that even prior to the pandemic, right? The average is roughly in the mid-20s, right? Sometimes it goes down to the lower 20s, but for all intents and purposes, I would say the midpoint is about 25 in the last 10 years worth of data. So that being said, not too bad. When we divide that by their PEG ratio, when we divide that by their EPS growth rate, rather, we get a PEG ratio of 1.67. Anything under 1 is a very good deal. Anything between 1 and 2 is okay, but you want to be closer to 1. And everything above 2 starts to get a little bit rich. So 1.67, I would not say it's quite bad at all. Now, if we were to give them a forward PE on average of 25 moving forward, that would give them a 2025 share price of $172.50, so kind of approaching terminal value there. And 2026, we get a valuation of about $198 per share. So that being said, guys, there is some possible upside, and the analysts tend to agree with us as well. As you can see, the upside targets are right about where with this most basic forward-looking analysis, right? About $200 per share. So yes, there is some upside, but is there screaming upside right now? Well, probably not. But Guru Focus, my preferred website for any analysis, does say that this one is modestly overvalued, right? It puts a fair price right there at about $135. So this one, guys, would possibly be an ad for me, but we kind of need a dip, right? And I'm not too sure Texas Roadhouse is going to offer us that dip. But in the event we come down into maybe the lower 140 range, that could be a decent area to possibly add some shares. As of now, it's a little bit too high. If we're holding shares from back here, then there's no reason to sell. But starting a new position, guys, the risk reward is not the most favorable. So beautiful company, but we're kind of coming into full valuation very, very shortly here. So yes, can there be upside? Of course, but the upside may be relatively muted, even though the company can continue to outperform and could possibly go well above its valuation. We can't necessarily say that right now we're getting a very good deal on it, right? So that's my thoughts on Texas Roadhouse. Now, number 3, Liz Houston, hi, can you do IoT for subscriber requests, please? Of course. So IoT, no problem at all. Let's bring it up. Samsara. So IoT stands for the Internet of Things, which is exactly what they're in the business of doing, right? The Internet of Things. So they're mostly having to do with Ethernet sensors and stuff like that, right? Really, in terms of connectivity, has been one of their largest businesses that have been expanding as of recently. So as a whole, guys, let's take a look at some of their fundamentals for the company, right? They've been on an absolute tear here, pretty much crushing the all-time highs over the last couple of months. So let's take a look at some of their fundamentals real quick. In terms of their balance sheet, so as we can see, guys, the company, unfortunately, as of now, is still not yet net margin profitable. They are increasing revenue aggressively, but still no defined path to profitability as of just yet. In terms of when that's going to happen, guys, the expectations are probably for 2025 or 2026. Now, in terms of EPS, they have turned over to a positive corner right here, as you can see, expanding EPS. And a very nice expansion of the revenue graph too. However, the revenue isn't expanding extremely fast, right? 19% is very, very good, but the company still is relatively small. It's $26 billion. Now, keep in mind, guys, the valuation here is a little bit steep, right? Let's take a look at those revenue numbers once again. So the revenue numbers in 2026, they'll barely be bringing in $2 billion. The market is giving them a market cap right now of $26 billion. That is kind of getting up there, guys. It's kind of a little bit rich, in my humble opinion, for this company. Even though they are growing well, I think they're growing right now beyond what their valuation actually supports, especially with the fact that they're not yet net margin positive, which doesn't really allow them to do any fancy buybacks, right? It doesn't give them any capacity to artificially boost their EPS. But the balance sheet is relatively good. No debt to speak of as of yet. Decent cash on the balance sheet, but I would be wary in the event they do have to raise any capital, because they are a money losing company per quarter right now. So they don't really have that much more money to burn on a quarter to quarter basis. So dilution is possibly on the table, and the acquisition of maybe more debt is obviously on the table as well. That being said, take a look at your numbers right here. Revenue expansion, 19% per year. That's good, but for a company with such small revenue numbers in relation to their market cap, I would like to see this number expanding like 30-40% per year, guys. In terms of EPS growth, like we just saw with Elf Beauty and CELH type of thing, right? Now, EPS growth at 87% per year, well, it does appear very, very high, guys, but keep in mind, they are coming off pretty much negative territory, right? So they are still only in cent increments, which is why you see the EPS growth rate is so high. That being said, forward P at 45 bucks is 264.7, completely normal, guys. It's a high growth company, and as we just explained right earlier, the EPS is not that large. And then obviously, when we divide this massive P ratio by their EPS growth rate, we get a peg of 3.04. That is just very, very, very high, guys. Even for a high growth tech company starting off, this is very, very, very high right now. And I do believe that analysts tend to agree with me. You can see there's only one remaining price target above us at 55. The average is currently sitting below us at about 44, and the minimum is about at 40. And that's probably where I would be more interested in maybe revisiting this company for a little bit of a swing trade. In terms of a long-term investment, probably not for me, guys. I don't really believe that they have that much of a competitive advantage or moat for a long-term portfolio purpose. But for a swing trade, I may be more interested in the event we start retesting some of these lower, or rather mid to high 30s, right? This whole 36, 37 level seems to be a great location to pick up a monthly higher low swing for possible further trend expansion, which is why I'd be targeting the retest area right down here, roughly about $36 to about $38, let's call it, right? So that's my view on Samsara. Not a bad company to speak of, but really coming into full valuation right now, right? We're not really getting a good deal on this one. But nothing wrong with the company per se. Now, Michael asking, any thoughts on APP? Applovin, if you get time this weekend, sure, Michael, let's have a look. So Applovin having one of their best weeks in company history, right? These past 3 days alone, pretty much the company is up 30%. Absolute monster increases by Applovin. Applovin actually hit the floor back here. I played this one back in the day, guys, early part of last year. I was playing it heavily in the 25, and I literally sold it at like 35 bucks, right? In this whole area of consolidation. And then it kind of ran away with me, right? But that's kind of the risk you have to take, right? The company was kind of oscillating between profitability and not during that time period. There was a lot of uncertainty in the markets, of course, but now obviously, right, $112 at the highs, looking very good, looking to attack the all-time highs. So what does Applovin do? Well, Applovin is very, very easily, guys. They're basically like the trade desk of mobile application games. So basically, they are a company that optimizes advertisement placement for mobile games. I'm sure you guys have played a ton of games on your phone from the App Store, and within those games, obviously, there is different advertisements, right? So Applovin, what they do is they have an AI software, kind of like Trade Desk does, right? Where the algorithm is able to pinpoint what is the best ad placement, what is the best ad type for this type of game, and stuff like that, right? So it's all about optimization for ads, and they've been getting a tremendous amount of business. Arguably, they are the industry leader in that niche of advertising in relation to mobile games. Now, they do have impressive growth to profitability here, guys. Take a look at this. The company was oscillating between 2019 and 2022, oscillating between positive and negative territory in terms of net margins. But look at the last 5 quarters. When they started turning the corner of profitability, look at the net margins as Q2 2023, 10.67%. As of their most recent quarter, guys, that is almost touching 30%. So massive growth to profitability. Love to see it. However, the growth is now moderating, of course, right? Especially in terms of the growth of their revenue as well. Let's take a look at that too. So in terms of the revenue growth is down here. Revenue growth is looking very, very good. You can see the ramp is here, but the ramp is kind of tapering off a little bit, right? I would say that they're in the highest period of their growth right now. Even though the total addressable market will be going up, they're kind of hitting peak growth right now. And even in terms of EPS, guys, you can see peak growth is pretty much for the next foreseeable future, this year, 25 and 2026, for the outliers for EPS growth right then. In terms of the balance sheet of the company, what are they doing with all that renewed profitability? Well, they're using it to start to pay down a little bit of debt. They're also bolstering very, very high amounts of free cash flow. This is what I love to see for a company. Now, what they're going to be able to do with this free cash flow is, of course, start paying down some of that long-term debt if they wanted to, or even start doing a little bit of share buybacks as they've been doing. They've been actually doing a decent amount of share buybacks, and they've been doing it twofold. So they've been doing 2 things to buy back their shares. Not only are they using the positive free cash flow, but they're also employing some debt to buy back shares. That's one of the main components of their debt additions in the last few years, was to buy back shares to kind of boost investor confidence. They started doing that all the way back here, and seems to be that it worked. Now, taking a look forward, guys, revenue growth through 2027 is 12% per year. EPS growth is about 21%. These are very solid metrics for the company indeed here, guys. Take a look. Their forward PE at $112 right now. Their current price is about a 33.2. First glance, a little bit high, but when we divide that by their phenomenal EPS growth rate, we get a PEG ratio of about 1.58. That is truly not bad for the company, guys. But I would not say it is a screaming deal right now. Yes, is there some possible appreciation left in the stock? Absolutely. And the analysts, well, a few analysts would agree with us, but a lot of the average price targets are now currently below us here, guys, which leads us to believe, right? Maybe back here was probably a perfect time to be picking up the company when there was a Black Monday sale, or possibly earlier back here in the months of, let's say, June or July, when we were more in line with the $70, $80 range. Now at $112, guys, it's excessively difficult for me to chase the company. That being said, if you guys have shares in this location that you've acquired, I still don't see any immediate red flags to be selling the company just yet, but I wouldn't necessarily be starting a position up here. Can we get some further ramp? Yes, the multiples do allow for some further expansion of share price, but are we getting a good deal? Probably not at the current time here, guys. I would rather take this, pick this stock up if we can somehow get back. It would need a tremendous market crash for this, right? If we can get back to the 80 to around $75 range, I'm much more comfortable with my margin of error in those prices in relation to where we are right now. So once again, this is another example of a great company, but the share price is just not so attractive for me right now, right? It's not screaming amazing entry opportunity. So thanks very much for bringing that one up, Michael. Now, Surfing Mermaid asking, can I please do an update on ASML? I bought some and then it tanked. Yeah, well, that happens to the best of us, right? So when we buy something, it tanks. We try to buy them low, but sometimes they can always go lower. So ASML, full disclaimer, guys, I do have this one as part of my longer term portfolio. I have about, let's call it about anywhere between, I have to check it again, between $13,000 and $15,000 in this company. It is one of only 2 semiconductor companies that I hold in my longer term portfolio. One of them is ASML and the other one is TSMC. I just think they have the best moats in the entire industry and the largest competitive advantages. So ASML, I love this company as a whole, guys. We covered them for earnings, but as you can see, I mean, I'd have to redo the valuation right here. My apologies for not doing it. Let me do it on screen with you guys. So what are we at right now? About 816. So let me just redo for 816. And we're going to do the renewed P ratio right now. So 816 divided by 20.32. That's going to give us 40.15. That's a bit lower, 40.15. And then we're going to divide this by their EPS growth rate, which is 21.5. About a 1.86 peg. 1.86 peg is really not that bad for this company at all. So with those renewed fundamentals, guys, let's take a look, right? ASML, extremely solid company. If you don't know what they do, they manufacture advanced lithography machines. It's a very fancy way of saying they manufacture the highest quality machines, or the machines with the highest technical capabilities in the world to manufacture semiconductors themselves, right? So each one of the machines that ASML sells is about anywhere between $250 to $500 million. If you guys don't know, if you guys have never seen these machines, they're absolutely massive, guys, right? Absolutely massive machines. And there's so many moving parts in these machines, and they manufacture tiny, tiny, tiny little semiconductor chips, right? In an extremely efficient manner, using their UV technology, right, to kind of engrave and manufacture those chips as a whole. So enough about that. In terms of their valuation right now, the company is extremely solid, guys. Their competitive advantage is second to none. Nobody else does these types of machines in the entire game. They also bolster extremely high net margins. So buying this company, net margins are not a problem. As of right now, they're in the mid to high 20% ranges. Now, in terms of the debt, company has no debt, no significant debt to speak of, a lot of cash on the balance sheet, and very, very high rates of free cash flow, which is why I love the company. In terms of their growth rates, take a look at this. Very nice EPS growth rate through 2027, and very impressive revenue growth rates as well through 2027. All of the analyst targets, every single one of them, guys, is above the current share price. So I really love this company, guys, anywhere in this current range right here, right? 815 all the way down to roughly 7, low 7s where we were. This, in my opinion, is a tremendous buying opportunity for this company, not only fundamentally, but also technicals, guys, right? Prior all-time highs acting as support right now for us. So you can see, just looking to kind of set up for the monthly higher lows, retesting our prior peaks right there. Very simply looking to kind of settle down before possibly embarking in a more multi-year recovery journey for the company, guys. So this, in my opinion, tremendous buying opportunity. I love this company. Nothing bad to say about the company at all. And as a matter of fact, if you want a more in-depth view of their most recent earnings, you can always go check out the video that I did about a month ago when they came out with them, right? So moving on, guys, let's move on to the next one. Thanks very much, Surfing Mermaid. Now, Miss Unique 65 asking, could we do EQIX next time? Yes, absolutely. So EQIX is a very interesting one, guys. If you don't know what this one is, it is basically a REIT, but it is a data center REIT. So obviously it's been getting a lot of attention in the most recent last couple of months, even up to about a year and a half ago, because it's the industry leader. Off the top of my head, I think the only other company that has data center real estate exposure in that category is probably DLR, right? DLR is the other REIT, but as a matter of fact, sorry, I'm kind of blanking right here. EQIX, sorry, I keep forgetting the ticker. So EQIX actually has the commanding market share for this one, right? Equinix. So moving into it, they have over 250 data centers worldwide. They're the industry leader. They provide hosting applications, guys. The actual real estate, the buildings, right, for these data centers, they provide services to a lot of your hyperscaler leaders, such as Microsoft, Amazon, Google, and Netflix, to say a few. And as a whole, guys, just a very, very solid company. However, this company is also suffering from some of the same fates that we've seen with some of the prior stocks that we just went over previously, right? So it's a beautiful, I don't know why I'm at that picture. So moving on. This company is a very, very solid company, but it's suffering from a little bit of valuation concerns right now. So let's have a look right now. The company is a REIT, so we can't really use any traditional metrics such as EPS and PEG ratios. They operate a little bit differently. They operate with AFFOs, which is basically an internal metric of the cash flow that the REITs are able to provide on a yearly basis back to their investors and obviously to themselves too, right? So it's a measure of cash flows. So as we can see, guys, in the last couple of years, their net margins have actually been expanding. Makes sense. There's a lot of demand for these centers, and they're able to organically increase the prices of that real estate and of those rents, of course, right? Now, taking a look right here, we can see that, not going to look at EPS, but we're going to look at the revenue. Revenue consistently expanding, guys, which is exactly what we want to see. And a lot of analyst targets indeed are in between the $900 to about $1,000 range. So the upside is, in my humble opinion, guys, somewhat limited right now, right? In terms of the upside, maybe about 10 to 20%, but we have to be a little bit cautious right here because they're trading above the industry standard. They're trading at about a 23.1 forward AFFO. The sector average right now is about a 16 times. Now, they're also trading at a 2.1% forward dividend yield, and the sector average is a lot higher at about 2.85%, right? So relatively low dividend yield as a whole. It just goes to show how much the share price has come up in the last few months of trading. Now, DLR, one of their other main competitors, see, the difference is they pay a 3.07% dividend, and as a whole, their valuation is just a little bit lower. But there's absolutely nothing wrong with this company as a whole, guys. I really like this company. The only problem is we're running into full valuation right now. So if you have some shares that that you might have priorly acquired down here in maybe the mid 700s, low 700s, I don't really see any necessity to sell the company right now. The company is doing very, very well, firing on all cylinders and providing much needed services in this current environment. And I don't believe they're going to have a slowdown in demand for at least the next 3, 4, 5 years, right? So it's benefiting from secular trend tailwinds, right? So that's what we love to see as well. As I wrote here, it is a great company, but the valuation right now is somewhat priced to perfection. So this one for me would be a hold. It wouldn't be a buy up here. It wouldn't be a sell, just hold if we have prior shares at a somewhat better valuation. But all in all, as I just said, guys, absolutely nothing wrong with the company, and it does pay a decent little dividend here of about 1.96%. So those are my views on EQIX. I do not own this one personally. The only REIT that I do own in my long-term portfolio, I've been very public about this one on the channel, is Vici, right? The landlord arm of the MGM brand of casinos and resorts, essentially. So thank you very much, Miss Unique, for that one. Very, very, very interesting play. Now, moving on to Nathan. What do you think about Boeing? With the recent Wells Fargo downgrade on the stock, basically reiterating that Nathan feels that probably if there's so much pessimism right now on the stock and analyst downgrades, it may just be a good location to buy this company. So Boeing, of course, guys, needs no introduction, right? They are a legacy company of the U.S. economy. And they're pretty much a duopoly right now. Them and Airbus, they're the only two people in the world that operate at the scale required to manufacture commercial airplanes, but also Boeing has a very, very large defense contracting business too. So they're very closely tied with the US government. So despite the woes that the company has been going through recently, like, the space shuttle incident in orbit right now where astronauts got lost in space, and then obviously the incidents about either Boeing planes crashing like we saw a few years ago with their 737 MAX products, or even other events such as the most recent year where they've had doors come off a plane mid-flight. The company's just been getting hit back and forth. They obviously have union troubles as well with their workers, some of their workers going on strike as of last week. So it's just not been a very good time for the company at all. However, with all of this negativity surrounding the stock, it begs the question, is now the time to buy? Because technically this is when you do want to start buying these companies, when everybody seems to hate them, right? The company, number one, is never going out of business. They have a duopoly. They will never sacrifice their duopoly. They will start to do better eventually, even though the recovery story may take a long time to turn around. And number two, the US government will never let them go bankrupt either, or go out of business because of their status as a defense contractor, right? They have very, very private information for military installations and defense purposes all across the world. So they're definitely not going out of business anytime soon. And as a matter of fact, right now, the company, they're not doing the best, but I wouldn't say it's a disaster, right? So yes, they have a lot of debt right here, 54 billion. Most of that was acquired after COVID, of course, because, their commercial aircraft business, with a lot of airlines getting absolutely destroyed during the peaks of the pandemic, a lot of new orders for planes were pushed back years and years into the future, right? Airline companies just did not want to spend the money on those new planes. So unfortunately, Boeing had to take on a lot of debt to keep their business afloat while they were burning large amounts of free cash all those few years. However, they have been steadily paying that debt down. As of now, they have a decent amount of cash left on the balance sheet, 12.69, and they have a decent amount of free cash flow that they produce per year. Now, in terms of the estimates moving forward, they are starting to recover their EPS losses. So as of 2025 onwards, they will be back to positive EPS territory, and they will also be back to revenue growth as well after this year, which is a bit of a transition year still. They will be moving on to positive expansion territory and possibly even turning around the net negative margins that they've been having over the past 5 years to more consistent profitability moving forward next year. So as a whole, this is a complete recovery story, guys. If we do choose to buy into this one, we're probably going to have to be very patient, right? But it is in the Dow Jones, and I'd be tempted to start some positions, not going heavy, but if you do want to play the recovery story on Boeing, I wouldn't make it a core position in a portfolio, to say the least. Like, it's not as solid as a company as, let's say, something like a Microsoft or a Google or something like that, right? A more tech name, and even some of the manufacturing names out there. Like, I wouldn't say that they're as solid as of a company as a lot of other industrial names out there either, right? Such as maybe something like a Caterpillar or a John Deere or other companies in other industries, right? So Boeing's not my first pick really across the board anywhere, right? But if you want to make a recovery play on this company, we're coming down into the ideal location, right? That's going to be pretty much 150 all the way down to 120. If you're interested in building a position down here on Boeing, going for that recovery story, right? Trying to possibly make a 2x over a long period of time for a company that's a legacy company. They don't pay a dividend anymore. But this area would be the best area, in my opinion. You'd be picking up at 2022 lows, the pandemic lows, and then price locations from 2016 and 2017. So it's coming into the kind of time machine price territory right there. So I wouldn't be opposed to starting a very, very small feeler position on Boeing, but I definitely wouldn't make it a core holding, guys. The business is just way too cyclical, in my humble opinion, to warrant a long-term investment from myself, right? They can stay down for so long before putting in that share appreciation. Just way too much of a cyclical business, not predictable and consistent enough for me. So hopefully that makes sense, Nathan. Now moving on to UAJISK. So what do you think about United Health? I don't think you've ever mentioned the gorgeous company. I'm looking to add more, but it's too high right now. What do you think? So yeah, UNH actually, as a matter of fact, was featured on one of our subscriber requests roughly maybe about a month and a half, 2 months ago at this point. And I did also cover their earnings on the channel about a month ago. I'll leave the link in the description down below there, but they had absolutely phenomenal earnings, guys. We actually played this company on earnings and made a decent amount of capital on them. So UNH, I have literally nothing bad to say about the company, guys. They're the USA leader in health insurance. They really don't need any introduction at all. They have an extremely stable business model. Now, their net margins are admittedly not the highest, usually on a per year basis. They're about 6%. Take a look at their financials right here too, so you can see their financials as a whole. In terms of their insurance, in terms of their policy claims versus premium earned, it's not even close, right? Usually they earn roughly about 5 to 6 times the amount in premiums that they have to pay out for insurance claims every year. So it's a very profitable business for them to be in right now. In terms of their growth in the future, guys, EPS expansion, clear as day, very consistent, very profitable. That's what I like to see in these forms of companies. Very high return on capital employed and return on invested capital as well. Now, fortress balance sheet, of course, very decent buybacks for the company, guys. Nothing bad to say. Do I still have this, the buyback chart up here? Yeah, let me pull up this different company. Let me pull up UNH real quick for you guys. So UNH on the buybacks, let's take a look. You can see very stable buybacks as a whole, right? Usually every single quarter moving forward. So I love it. Love it. There's only a few headwinds: Medicare and Medicaid spending and the rising cost of medical services, right? If they get less subsidies from the government, well, obviously they won't be able to, they're at a risk of possibly losing some of their customer base, right? Because a lot of their favorable pricing for consumers relies heavily on their ability to obtain subsidies from the government. That's what allows them to keep some of their premiums lower than they would otherwise be without those subsidies. And then the rising cost of medical services as well, that could also eat into their margins, right? You can only increase healthcare premiums so much per year before losing a lot of customers, right? So it's really a big balancing act. This point right here is, in the event you're only raising premiums, let's say 4 or 5% a year, a little bit more than the rate of inflation. But let's say the cost of medical services, when people go into the hospital, let's say those costs are rising 10, 15% per year. I'm giving a theoretical example, right? If the cost of medical services increases faster than the company's ability to raise insurance premiums, well, then it's going to cost them more money for payouts when people put in claims, right? So that's going to wear down their margins a little bit. So those are the only headwinds we have to be mindful for. Other than that, guys, such a solid company, very stable revenue growth per year, very stable EPS growth per year. And we did their valuation at $5.11, but let me redo it real quick. Do we still have the same EPS number? $27.70. Yes. Let me just do this in front of you guys real quick. Apologies for that. So let's do it at $5.94. Then I'll give you guys an idea for the technicals, because I mentioned this one a few times on the channel in the last week, and I'm very, very interested in positioning myself in this one, but it's just not ready yet. So let me just redo these numbers here. I should have done them before, guys. My bad. 594 divided by your EPS, 27.7, is about a 21.4. So that's a little bit higher than when we did it at 510. 510, it was a screaming buy, by the way. So 21.4 divided by their EPS growth rate, about 16%, gives them a peg about 1.34. 1.34 is not all that bad for the company, even all the way up here. Whoops, I don't know what I did right there. My bad. So, I hit the replay button. Do you want to exit? Yes. Sorry about that, guys. So moving forward, guys, UNH, right? Great company, solid fundamentals. What I will be looking out for. Look at this monthly chart. Beautiful monthly uptrend. I'm waiting for a back test potential, right? 560 down to maybe 540 if we can back test. As of now, it's not giving it to us, right? It gave it to us a little bit back here, but now we're kind of running away on the weekly, right? However, if healthcare goes into a little bit more extended consolidation, or maybe we get some more recessionary headlines, and the company somehow makes its way back into 560, 550 for the retest of this range, that will be such an amazing company here, guys, for a beautiful little swing trade. But in terms of a long-term investment, guys, in my opinion, there's never really a bad time to be buying into UNH. Obviously, this period of consolidation was probably the best time to do it. But even now, as you saw, the valuation is not super high, and you are getting one of the highest quality companies in the world with extremely solid fundamentals, guys, right? And they do have a very, very large moat. So that's pretty much everything for UNH. Hopefully you guys enjoyed that. Now, moving down to Ethan, can you do a rundown on CELH? I saw it was down 10% today, but I see no news or catalyst that would trigger such a massive drop. Seems like a good buying opportunity. So I answered Ethan in the comments, but the reason I brought up CELH is because there must be a lot of people looking at this company, and with good reason, right? It has sold off an astronomical amount from their all-time highs, double topping for all intents and purposes at $100, and now they're roughly 66% off. Now, the reason for the drop, guys, is roughly twofold. Number one, they're coming off of very, very, very high growth rates. You're talking about a company that was growing year-over-year revenues in excess of 70, 80% for a very long period of time, right? For pretty much the past 2 years. Now, the growth rate, even though very, very strong still, look at these growth rates, guys, 20% per year, right? It's not what it was, right? So it starts off very high, 70%, then down to 50%, then down to 30%, and now we're at 20%. 20% growth per year, guys, is still absolutely crazy for any company, right? So let's not get it twisted. The revenue growth rate is still very high, but it's the year-over-year comparisons that are difficult right now. And then number two, of course, we're facing a consumer budget slowdown, right? Discretionary spending, we know, has not been the best, which is why a lot of your high-flying growth names in the consumer discretionary segment have been coming down. Them, Elf Beauty, unfortunately, has been hit with the same fate, just because the company is providing a little bit timid guidance, right? They're acknowledging that the consumer is a little bit weak right now, and they're kind of being very cautious about the outlooks that they give for the next couple of quarters. But all in all, the company, in my humble opinion, guys, is a very solid company. Now take a look here. The market cap right now is $7.85 billion. So let me change this right here. $7.85 billion at 34 bucks. So this is one of the cheaper valuations out there, guys. Monster right now, if you want me to give you an idea, right? Monster is trading about $50 billion right now. And Red Bull, which is another one of their competitors, unfortunately, Red Bull is a private company. They do not have a stock, but the estimate is that Red Bull is roughly valued between $80 and $90 billion. Now, the good thing about this company, guys, is they're the top performing, top selling brand on Amazon.com for the last roughly year and a half. So they're outperforming Red Bull, they're outperforming Monster in that respect, and they're branded as kind of a more healthy option, even though their ingredients can be questionable by certain metrics, right? They are a more healthy opportunity than possibly Monster beverages and Red Bull beverages, even though these two guys do have their own healthier segments within their brands. CELH as a whole is just it's just the way they brand and market it, right? It's a more healthy lifestyle brand for energy drink purposes, right? Now, that being said, the valuation right here, let me just redo it once again. We did it at $38 literally about 2 weeks ago. Now it's even lower. So roughly it's about 10% lower. So the PEG ratio right now should be about 1.15, 1.2. Not that large at all, guys. So this, if you like this company, in my humble opinion, this is exactly where, if you have a long-term vision on the company, it's where we should start accumulating some shares, right? No debt at all. Decent amount of free cash flow and decent amount of cash on the balance sheet. No problems for this company at all in that respect. EPS growth, very steady for the next 3 years, even though this year is going to be a little bit slower for them, especially the tail part of the year when they reduce that guidance. And revenue expansion, even though 2024 is flat, when the economy resumes and CLH resumes its growth trends, it should be fairly good, especially mid-2025 and onwards. So the company is facing the same headwinds as the rest of the industry right now. The whole consumer discretionary segment is facing these exact same concerns. Now, in terms of so the valuation right now is very, very good, guys, right? This is arguably cheap for the company. The technicals, weekly oversold conditions. We really have not had weekly oversold conditions this poor since pretty much all the way back here in 2011. So it's been a very long time, and the company is obviously a much different company than it was back then. So I like this, guys. Low valuation with still high growth, out of favor right now, and weekly oversold conditions. This is probably where we can start accumulating some shares. This lower location of support down here, which kind of, I know the box only stops at about 31, but you guys can see there is a lower level right here at about the $27 mark. So what I'm kind of saying is mid 30s down to mid 20s would be the location where I am likely to accumulate some shares for a longer term swing trade position or longer term buys. As a whole though, guys, if you want this one to really start showing signs of life, you're going to eventually need to see the start of a formation of a weekly uptrend. Until we have a weekly uptrend, we cannot say that this monthly consolidation is stopped just yet, even though it is coming into a very wide area of support. So I like this one a lot in these lower price levels, guys. Good fundamentals, good growth moving forward, just out of favor as part of the general consumer discretionary trade right now. Now, moving on further, we have Prod here asking, hey, Will, love the insight on the markets. Can you take a look at Instacart? I'm curious about the company long-term and some background on the CEO. Thank you and great content as always. So let's take a look at Instacart right here. So Instacart had their IPO just a few short years ago, right? I've never really played the company much other than for short put purposes here, and then a couple times when we retest the support range up here, but I do not own this company as part of a long-term portfolio. I'm a bit nervous about their competitive advantage moving forward over the long term, especially with stiff competition from the likes of either, Amazon or Walmart delivery services, or possibly Uber grocery delivery services, DoorDash, stuff like that, right? So they have a lot of competition right now moving forward. Now, in terms of the CEO, I wish I could tell you more about the CEO. It's not as if I know her as being a veteran of the game. I knew she held an executive role prior at Facebook, more specifically for app optimization purposes for the Facebook app. So, since Instacart is roughly the same type of platform, all app-based, it's a grocery delivery service on an app where it hires third-party drivers, kind of like Uber, right? Where somebody goes and picks up your groceries for you and then kind of delivers them to you, right? And the company has been kind of under the gun, especially in the most recent year, guys, because drivers feel that they're kind of getting short-sticked right now. The rates for providing services to the drivers have come down significantly over the last couple of years since the app was created, right? So you can go all over Reddit, guys. It's not just me, right? Another one for about a month ago, a slap in the face, the CEO should be ashamed. So that's possibly why you're asking about questions about the CEO. Here you can see, right, 36 item grocery shopping list. So I don't know how large that order is, but as you can see, guys, only $4.82 for about a 1.7 mile trip, plus no tip at all. So that being said, right, you have some people commenting, Instacart CEO bathes in orphan tears when she's not hunting for Dalmatian puppies to turn into a coat. So, that base pay is crazy. Instacart is getting cheaper year by year. see people saying, Sai, I remember when it was 50 cents an item plus $10 or something crazy. When I started, base pay was never under $20. You can go through this thread, guys. A lot of people who have been driving for Instacart for a very long time have either quit or are really concerned about the direction that the compensation plans are moving for the drivers, right? So that is my largest concern. That coupled with increased competition from other services, especially Uber, guys. The reason I love Uber so much is because they're an octopus. They do everything that all these other services do, and they're the biggest in the entire world right now, right? In my humble opinion, Uber is going to assimilate everybody else's businesses within the next 10 years. In the next 10 years, in my humble opinion, there will probably be no more DoorDash, maybe even no more Lyft, maybe no more even Instacart, stuff like that, right? Uber is just it's going to be winner takes most for that industry as a whole. It's unfortunate to say, but that's just my long-term view on that industry consolidation, right? Uber is just going to have a field day, just outscaling everybody into international markets and just driving the prices so low that people will just refuse to drive for other apps necessarily, right? So that is really the challenge right there is Uber going to be able to basically price everybody else out of the game? So the CEO of Instacart right now, she used to be an executive for Facebook, as a matter of fact. And the sentiment around her is not the best. Now, I wouldn't say that it's entirely her fault in terms of the direction of the business right now. Obviously, she has a lot to do with it, right? But maybe it's just the company's business model is not is not the best to really scale up, right? And have and compete directly with these other services. That is my humble take on the matter in terms of the CEO. Now, I know she does sit on the board of directors for other companies like Shopify, so she does have e-commerce experience. It's not as if she's not experienced as a whole. Now, in terms of the longevity of the company, I've already expressed my views, but let's take a look right here. In terms of the financials, guys, you can see that no debt to speak of, so that at least is good for the company, right? A lot of decent amount of free cash flow, no debt, and a decent amount of cash on the balance sheet. In terms of their net margins aren't bad, oscillating between 8 and 15%. It's really not bad in terms of net margins. In terms of the growth, guys, you can see they're now going to become EPS positive 24 through 27, so that's decent too. Excuse me. And revenue will also be expanding at a somewhat modest pace, right? Revenue growth of only 9% per year. I mean, that's not the best, right? Take a look at Uber, right? Uber is the best in the game right now. Uber is expanding at a higher rate, right? This is a $152 billion company. They are expanding at a faster rate than Instacart, which right now is only a $9 billion company. It's not enough. When the company is small, you need to see this number be higher than the highest competitors in the game. And unfortunately, it is just not for them. So that being said, let's return to the valuation. EPS growth of 21% per year is fairly good. The forward P at $37 is a 32.4. Not bad. And when we divide that by their EPS growth rate, we get a peg of about 1.54. Not the worst, admittedly, for Instacart, guys. But if I were to play this company, I'd have to get a much better deal for it because I'm just not convinced at their longevity or the long-term feasibility of their moat per se. A lot of analysts do have price targets in the mid-40s, but if I wanted to play this one, guys, for me, it would have to be $32 or lower, right? So in the event we get another tech market sell-off, similar to the ones that we had in early August or the midpoint of September, right? If we come back down and start challenging the $32 to $30 range, there might be a swing trade opportunity here to start retesting the higher 30s, but that's the extent that I would maybe like to play this one as a whole. Obviously, it's up to you guys, right? But thanks very much for bringing that one up. I hadn't taken a look at a more in-depth dive on Instacart in a while. And now lastly, Michael, again, asking another awesome video. Is it too early for Disney? Maybe private equity will come to the rescue once again. So I answered Michael's comments directly, but I just wanted to bring up Disney again, just because a lot of guys may be asking the same question, right? Is it finally the time to give Disney a chance? Well, I did a full breakdown of their company earnings, guys. I will leave their company earnings link down below in the description. So if you want a 10-minute, more in-depth view of their earnings and my opinions on the matter, I'll leave it down there. But right now, just very quick overview of the company, guys. Yes, to answer Michael's question, I do believe it is now finally the time for Disney. I was not convinced, admittedly, and I was open about this on the channel all throughout last year. The turnaround story was just not manifesting quickly enough in my humble opinion. Their streaming business was not yet profitable. They were having problems in further monetizing their parks, so their parks were running out of purchasing power, and there was a lot of investor and customer fatigue around their movie franchises, right? There was a lack of originality coming out of Disney, only just sequels and sequels and sequels, and eventually people do get sequel fatigue, right? It's a well-known thing. But as of now, those three things for this company have been addressed by the management team, and they are now taking concrete steps to move them forward. And I really liked what they said on their most recent earnings. Streaming is now profitable. The parks are somewhat out of pricing power again, but they are remodernizing their parks. They're starting to include new rides, taking ideas and suggestions from everybody and stuff like that. So they're trying their best now to improve a somewhat stale park experience over the last 3-4 years and kind of reinvigorate it. So I like to see those steps taking place by management, which you can see right here. Heavy CapEx, modernizing and reallocating capital here to increasing their cruise offerings and also increasing their, the productivity of their parks and, renew user interest or customer interest in their parks, right? That being said too, we're pretty much at the start of the recovery story in terms of their fundamentals, right? So fundamentals will be improving back to decent EPS growth 2024 onwards and very decent EPS revenue growth as well. 2025 more than the rest onwards too. So I do believe that this is now the time to start a position on Disney if you are interested, of course. PEG ratio at about 1.03, looking quite good for the future, guys, plus all the inflection points that I've been looking for the company. I like it. I actually like it. I like their earnings report. I did not like it at the same time last year, trust me, but now I actually do. So I publicly have a new position on the channel, guys, which we started roughly after their earnings back here at about $85. I have two positions. I have some shares that I acquired, and I also have a 2026 December leap call to give them a chance, right, at this potential rally. But I really do like Disney moving forward. I wouldn't say that I'm expecting something like this, right? Like an NVIDIA run? No. But are they going to be able to slowly but surely recapture the levels towards, eventually the low to mid 100s, like 120 to 150 bucks? Probably, guys, and that's what I'm going for the company. I do not think that these analyst targets are, inconceivable for what the company can do over the next year. 110 to 133 by the end of 2025. That could be a fairly in line with what people are actually estimating, right? You can see right here from February to April, they actually put in that rally. So in the event Disney, gets more favorable in institutional graces, and we can move through these recessionary concerns without too much impact on Disney's bottom lines, well, then probably by the mid to end of 2025, the company should have a higher share price than they do have right now. So I like Disney right now. It's not a very large position for me, but I am taking a chance now on the company, and great technical entry as well, guys, right? This is pretty much the lows. Time machine prices, right? Either the depths of 2022 or COVID or all the way back to 2016, 2015. So I like it. So that's pretty much everything we had for today's video, guys. Thank you once again to all of your suggestions for these tickers. I love doing these styles of videos. As I said, it just gives me an opportunity to possibly visit some companies that I either haven't heard of ever or possibly haven't revisited in a while. So thank you for all of your suggestions. And if you want your ticker to be featured, your ticker or your company that you want me to evaluate, if you want it to be in the video, guys, you know what to do. Leave a comment down below in today's video or in any one of the weekly videos, Monday through Friday, the daily market recaps, right? And I'll be able to review your tickers at some point at a later date. Usually I do these videos every 2 Saturdays, right? Every 2 weeks moving forward. That's probably going to be the norm. So thanks very much again, guys. Hopefully you enjoyed today's video. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing to the channel if you're new as well. Thank you so much for helping me crack my 3,000 subscriber milestone. Super happy, guys, and looking forward to smash a lot more milestones with you guys as well. And lastly, guys, if you have any questions at all, please feel free to leave them down below in the comments. You guys know me best. I always usually get back to you in the first 24 hours. So take care, guys. Have a great rest of your weekend. I'll see you tomorrow night for the top 5 options plays for the upcoming week. Peace.